Hi, everyone. Welcome to the latest Global X webinar. Today, we're discussing what we believe could be the underpinnings of a super cycle in the commodities sector. And so we're going to discuss, what those underpinnings look like, what investors should be looking for, and how they could invest in this burgeoning sector. My name is Chris McHaney, Head of Investment Management and Strategy here at Global X. I'll be the host of today's webinar, again, going through some of these trends and ideas that we think make sense for a lot of investors in the commodities space. What we'll cover today, first of all, we'll again go through what we think some of these underpinnings are that are indicators of what could be coming in the commodity space and what that means over the long term. We'll dig into a couple of these commodities a bit more specifically, and then we'll take some key takeaways as to how we can invest in this sector and what some of the risk-return trade-offs are for investors going forward. So first of all, I think it makes sense to think about commodities in the long term. Commodities really do tend to trade in long-term cycles. That's why we use the term super cycle. This can really last 5, 10, even 15 years in terms of the length of that commodity super cycle. If we take a look back at some of the previous cycles we've seen here, we compare commodity exposure to equity exposure. And again, you really can see the waves that commodities go through over time. And it's really, when we talk about super cycle, we talk about the commodity cycle in general. I think it's important to keep in mind there's really 3 phases to a commodities cycle. First is that expansionary phase where demand really outstrips supply. So demand is growing over time, and supply a lot of times can be constrained, as we'll see, particularly with a few specific commodities. It's not easy to turn on new supply very quickly when faced with new demand. So in this expansionary phase, demand tends to outpace supply, and supply is like fighting to keep up, and we tend to see rising commodity prices in this phase. And again, some more investment to bring more supply online. That second phase really is more of a peak phase where supply does catch up to that demand. Prices become a little bit more stable, and that supply and demand equation is a little bit more in balance. And then that third phase is really a contractionary phase where for one reason or another, demand fades, demand wanes, and potentially supply is oversupplied as well. And so that supply-demand imbalance gets back out of whack the other way, and then commodities fall in price. And then that leads to another expansionary phase over time. One thing you'll see from the charts we have here, so first of all, maybe I'll describe this. Our orange chart is that commodities to equities ratio, and you can see again how that has moved over time through various years. Interesting, those 2 spike ups that we see, those coincide with equity market sell-offs. So the equity market has gone down a lot in value. Commodities tend to hold their value in those type of environments, and therefore in these sort of scenarios can act as a very good hedge against falling equity prices. This is something we'll mention again a little bit later as very important, particularly given the stock bond correlation we've seen in recent years and how those 2 assets are starting to move together. Having something that is a bit uncorrelated to the equity market and doesn't drop significantly when equities do can be very valuable in the portfolio. The other thing we'll mention here is the darker line is that sort of US dollar on a trade-weighted basis. So on a global currency basis, how strong or weak is the US dollar? And you can see really it's almost inversely correlated with the value of commodities. When we have a strong dollar, that commodity to equity ratio is lower. And then when the dollar sells off, that tends to be a good environment for commodities. And so if we look on the left-hand side here, what some of these indicators are and some of these things that are happening in the market right now, they do tend to bode, negative for the US dollar over the long term. We think about something like deglobalization. This is a trend that has been in place for a few years now. The US is actually somewhat leading this with their trade policy, becoming a little bit less important in terms of that global trade scenario. So as countries start to become a little bit more insulated, as products cross borders a lot less than maybe they used to, the US dollar as the traded currency of the world tends to become a little bit less important. So less demand for US dollars from that standpoint. As well, with global deficits expanding, particularly on the US side, but elsewhere as well, that tends to lead to a depreciation as well over time of that currency. Short-term rates tend to push the currency up, but those long-term rates tend to show a currency that's going to weaken somewhat over time. And so again, we have a couple of scenarios here that probably are going to lead to a lower US dollar over the long term. Inflation concerns, of course, one of those as well. And so again, these things set up very well for a weaker US dollar and again, potentially commodities to reverse what we've seen as a huge underinvestment in this area over the last number of years. The last thing I'll point out here on this slide is, the last time we did see the commodity to equity ratio as low as it is now was in the late 90s and the early 2000s, that sort of dot-com bubble. A lot of similarities to what we see in the market today. And I'm not comparing today's tech companies to the dot-com tech companies, but really what it means is, investor capital gets sucked up in the sort of hot area of the moment. And in the 2000s, it was the internet bubble. It was this brand new thing that took a lot of capital market investment dollars. And so really commodities as a result, almost get ignored at that time. And that means underinvestment. And that means, as I mentioned previously, supply cannot come online quick enough when demand does pick up. Now we'll take a look at a couple of commodities specifically. Uranium is the first one here that we're going to talk about. This is something that has been in the news quite a bit recently with the recent trend towards AI build out, AI data centers, and the amount of power and energy that AI in general needs. Again, this is a relatively new source of demand for uranium and for nuclear power in general. And as we're going to talk about, a couple of these new sources of demand, again, lead us to think that we are in this expansionary phase of this commodity super cycle where all these new sources of demand are coming online, but not necessarily the supply to keep up with it. Apart from that sort of new demand coming from the AI and tech space, there's also this concept of energy security. This is really what came in the last couple of years on the back of Russia invading Ukraine. At the time, a lot of European countries were very concerned about the natural gas they would get from Russia. And of course, this has only expanded over the last number of years as global conflict continues, and if anything, is continuing to rise over time. And so government self-interest in having that energy security and dependence on no one else for energy is what's driving a lot of investment here as well. And then thirdly, for uranium in particular and for nuclear energy, very little carbon output from this. And so a lot of countries that have these sort of decarbonization goals and pledges to become net zero can actually still achieve that while increasing their overall energy power or energy output, but still, again, at the same time, not overly going against some of these previous pledges that they've put into place. So looking, again, going back to that first part of that demand, that AI-centered demand, you can see how it's ramped up significantly in the last few years. The middle of this chart, you can see it's sort of a 4.4%. This is the total percentage of consumption, of energy consumption that's brought by nuclear. And so you can see that has been growing over time significantly in the last number of years, but again, only really set to start to take off now. As we see this pickup from the AI component. Just of note, China in particular is developing right now about 150 different nuclear reactors across their country. A lot of that is to meet growing AI demand as well. And so here domestically, it's going to take a lot more time to bring that number of reactors online. Of course, we have seen recent deals from both Meta as well as Microsoft securing their own nuclear power. And so again, this is something that A, is increasing the demand component, but B, is also bringing together something that I just mentioned in the past slide, those investment dollars, those capital market dollars that have been so invested in tech over the last number of years. It's been the right call to be there because that's where the growth has been. But now that tech world and the demands of that are converging with the energy world and with the commodities. And so the amount of investment that has been happening in tech is now going to be bleeding over into the commodities space, because a lot of these new developments need a lot of their own power, of course. And so we're starting to get this intersection of those capital market dollars that have been so intensive in the tech area starting to move to the commodities area in a related way. And so moving again to the supply side here, as we can see, this orange piece of this chart shows the imbalance of the uranium supply relative to the demand. So all the different sources you can see in there right now still leads us to a little bit of a deficit in terms of the uranium supply that we have right now, to the amount we're allowed to, or we're able to bring online. So already in a deficit position. Maybe with new supply coming online over the next couple of years, that could get us back to balance by the late 2020s. But certainly by 2030, as you can see here, again, this is a base level projection, not really in the similar way to this one that could go exponentially. Base level projection shows that by 2030, we're going to be in a deficit for uranium, and it's only going to get worse over time from there. So again, thinking about the long term, thinking about this from a super cycle sort of exposure and sort of time frame, this is one that's going to lead to that deficit in supply, and therefore likely going to need higher prices in order for more supply to come online and to incentivize other companies to enter the space. For ways to explore this particular opportunity in uranium and nuclear specifically, we offer two different ETFs that investors could consider. The first, the HURA is the ticker, the Global X Uranium Index ETF. This ETF offers about 12% exposure to physical uranium, so it's to the price of uranium itself, about 12%, and the rest of the portfolio made up of uranium miners and uranium producers. And so, largely global in exposures, countries from across the world, a lot in Canada here as well that we have, but a global equity portfolio with, again, about 12% of the portfolio directly invested in the price of uranium. The second one on the right-hand side here, a little bit of a different approach. MTRX is the ticker, and this focuses a little bit more specifically on the AI opportunity. This is the Global X AI Infrastructure Index ETF. And so when we were talking about demand from power centers and demand from technology, this ETF really leans a little bit more towards that and the data center build out and the build out that's happening around AI. So this is not just another tech fund that's going to buy more NVIDIA and semiconductors for you. This is really focused on the industrial components. And so over 40% of this exposure exposed to industrials, another 20 plus to materials. And then we have energy and utilities in there as well at significant weights. The IT weight in this ETF is actually only about 14%. So you're not getting overlap with other IT stocks. Again, a little bit on that energy story and on that commodity story, but more specifically as it relates to artificial intelligence itself. Next, we'll go to copper and lithium and what the dynamics look like for these different commodities. Copper is another area where we are already in a deficit based on the supply we have and the demand that we're going to need over the next few years. You can see this really only going out to 2027 and only getting worse over time in terms of the copper demand that's going to be out there. Now, copper itself has historically been tied to cyclical activity. And so as we do expect global economic demand to potentially slow down, potentially as tariffs weigh on the consumer, we could see less GDP growth on a global basis. That could be a headwind for copper, and traditionally it has been. Now we are going to talk about, again, another couple of newer sources of supply or sources of demand for copper. And so we could see a little bit of a different result. Again, should economic activity slow down, there could be other sources of demand that take its place. And so even though largely levered to that pace of economic activity, copper could still be, again, particularly over the long run, could be in need for a great amount of investment as well. Sorry, maybe I'll just go back to this one again, just to talk about, first of all, we talked about the demand from AI and AI build out for uranium. Well, very much the same for copper as well. All those data centers that need to be built out all the connections, all the electrical build out, as well as the electrification in general of society as we build more EVs, etc. That's going to introduce a demand for copper that maybe wasn't there in the past, particularly over the next few years. The AI build out, that money has been spent. That money is allocated and been spent. Even if we see a sharp slowdown, the hyperscalers that are investing in this area are flush with cash. Even if their short-term businesses suffer a little bit, the spending and build out here is still going to continue because they see this as the next future growth potential. One other new source or potential new source of demand that we could see for copper is in defense spending. This is, again, another global phenomenon, largely led by the US. In Donald Trump's first term, I think you can remember him telling NATO and all the NATO allies that they need to start spending their fair share on defense. All those NATO countries are supposed to spend at least 2% of their GDP on defense spending. And only now are we actually starting to see that come to fruition. We've seen Canada ourselves, recently indicate we will reach that 2% spending this year, not the 5 years that was previously forecast. And so that is spending that's coming forward. We've seen that out of Europe as well, some of those countries increasing their defense spending. Now, what does that have to do with copper necessarily? Well, where is that new defense dollar going? Where is that new spending going? It's going towards cyber technology. It's going towards cyber security. It's going towards drones, and it's going towards more technological oriented defense spending. And so again, you could think about similarly the AI build out with data centers. Defense and defense oriented spending is going to need a very similar build out, which takes a lot of this metal as well. Now, this is interesting because, again, this is a newer source of supply or source of demand that previously we didn't necessarily have. And it's also not really related to the global economic environment. If we do see an economic slowdown, defense spending is still going to happen. This is based on strategic military priorities and policies, and therefore is not going to really be dictated by overall global economic activity. So another potential new source of demand that's not going to wane for copper. Lithium is in a very similar space. Lithium, of course, used a lot in batteries and battery technology. You can see right now on the left-hand side of this chart, we're actually in a decent balance in terms of that lithium market, in terms of that demand and supply, really in a good space right now. But very soon, even by 2030, that will face a deficit. And by 2035, 2040, significant deficit, as we'll have about twice as much demand as the supply that we have. As you can see here, not really much new supply coming online over time. Again, another underinvested and underfunded area that only is going to need more of that going forward if we are going to continue down this path of what we're expecting in our global markets, as well as where we're moving towards electrification in general. So 2 different ETFs that we offer that can cover off this area of investment. COPP, of course, focuses on copper. 20 plus largest copper miners, again, globally. We use ADRs where we can here, and so it's a very efficient, very liquid ETF that focuses on the upper end of those copper producers, really the largest companies in the name. And then HLIT, for more pure lithium exposure, built in a similar way. And now the last area we're going to touch on specifically is gold, another area that's actually been very topical recently, given the run-up in gold that we've seen in reaching over $3,000, all-time highs. What's driving that? There's a few different things here that are really driving the price of gold. Of course, that macro uncertainty is really a big part of it. Tariffs and what that means for global trade really is a huge unknown that could affect global companies and global economies. And so we've seen a rush to gold there. Also, central banks purchasing gold, and we'll put some numbers behind that, but a significant increase in the amount of gold that central banks around the world are buying. And then one other thing that works in favor of gold prices is when interest rates come down, and potentially we'll see those short-term interest rates starting to come down a little bit. Typically because gold is not an income-producing asset and doesn't produce anything, when real interest rates are low, that tends to be when gold performs at its best. So first of all, let's look at gold as a safe haven currency or type of currency. Again, we compare this to the equity price itself, or gold prices versus equity prices. That's the orange line in that ratio. And you can see really during each crisis that we've had over the last, call it 5 to 10 years, that gold price has really rallied. In fact, we do have another chart. We haven't used it in this particular slide deck, but we have another chart going back 20 plus years that shows all the major equity sell-offs that have happened over time and the various reasons for it. Each time when those equity markets are down, what has the gold price done in those environments? Almost every time, not only is gold done better than the equity market, but has actually been positive in those market environments. So when equities are down, gold actually being positive to only slightly negative. So can provide a very nice hedge against that equity market risk in the portfolio. We think that's actually very important right now in this sort of market environment, because bonds have really lost that hedge against equities. As we've seen in 2022 in particular, the balanced portfolio did not do very good at all, that 60-40, as both equities and bonds sold off. And when bonds and rates are the source of volatility, that tends to lead into the equity market as well. That way you get a higher correlation, you get assets selling off together. Similarly, in April of this year, when we did see a little bit of extra volatility in the markets around those tariff announcements, we saw both bonds and stocks, particularly bonds in the long end, sell off as well. And so this correlation of stocks and bonds, we think, is increasing over time, and bonds can't necessarily be counted on as that offset to equity risk. And so gold playing the role there over the last number of years. The other thing we mentioned was this central bank purchasing of gold and how that's really accelerated over the last few years. ECB actually recently put out a report that showed gold is now the second largest held global reserve in the world. So of all reserve assets globally, gold is now second in terms of popularity at 20% of total reserve assets. US dollar being 46% of total reserve assets, by far the highest. Gold is now second with 20% of those global reserves. The euro in third place at 16%. What's driving some of that? Again, we can go back to the Russian invasion of Ukraine. Once sanctions were put on Russia, we really saw a huge increase in the amount of gold reserves that central banks were buying. And this feeds again into that concept of de-dollarization and less importance of the US dollar on a global basis. Central banks around the world have been buying about twice as much gold as they have in the past pre-2022 in order to diversify the reserves away from the US dollar. And which countries are buying it? It is those like China. But as you can see on this chart here, still only 7% of reserves in China are held within gold. And so a lot more can go there without, again, really over purchasing from that sort of global reserve perspective. So we think this trend is going to continue. Again, US becoming a little less important on the global stage, particularly when it comes to trade. Less reason for central banks to own US dollars, more reason to diversify away, and therefore gold has been a large beneficiary of that. In order to get exposure to that physical gold price and to the price of gold itself, we have two different options here. HUG is a futures-based ETF, so we're going to track the price of gold through futures. That tends to be a very liquid way to track the price of gold, better than moving physical gold in and out when money's moving in and out. And so very, very efficient way to track that gold price. And so for those that believe the forecast that gold is going to $4,000 or even $8,000 over the long term, HUG would be a way to track that price for you. Another solution we have that creates a little bit of income for you is HGY. That's the Global X Gold Yield ETF. And this one holds physical gold through an ETF. And so many ETFs that are set up to hold that physical gold bullion. And so this ETF holds an ETF that holds gold bullion and then uses an option overlay program, a covered call overlay for those that are familiar with covered calls, to create an income stream. Gets a distribution that has been in the 5 to 6% range over the last number of years. And so creates an income stream out of a non-income producing asset. And so that one's been very popular for us as a way to, again, get some income out of a non-income producing asset, but that can still benefit from the price of gold going up over time. Now, for those that think, okay, gold might be at a peak here, I'm not really keen on buying gold at all-time highs. Another way to gain exposure to this area that really hasn't experienced that huge run up is through gold equities. So those miners that dig up the gold and then sell it. This gives you leverage to the price of gold because these companies are borrowing and have the capital markets backing to them. They are leveraged to the price of gold, and as gold goes up, you should see a benefit from these even more so. The great news of that, of this as well, again, because gold at an all-time high could be hard to buy into, thinking that it's going to keep going up. Gold equities, even though we have seen a rally from them, certainly this year in 2025 and late 2024, even though they've done very well, still very value on a PE basis. So very well valued on a PE basis, very attractive. Just over 10 on a forward-looking PE, and you can compare that to the broad markets, US in the 20 to 25 range. Here in Canada, we're at about a 16 on the PE basis. So this is an area that you can gain access to that gold and to that story of central bank purchasing, to that high gold price, to inflation protection, but do it in a easily valued way or a better valued way through those gold equities that are very cheap, just again about a 10 in terms of that diversification, in terms of that valuation, and also provides diversification to the broad markets, about a 0.4 correlation historically, gold equities to broad market equities. So you're adding an element of diversification into your portfolio here as well. So I mentioned GLDX was the ETF we were looking at there with the great PE ratio. That's our Gold Producers Index ETF. For those that want a little bit of income, we take that same portfolio and run an option overlay, a covered call overlay on that as well. That's GLCC, the Gold Producer Equity Covered Call ETF. And so again, that'll give you a nice income stream on top of that growth potential that these equities can offer you. I should also mention we have GLCL. For those that want a slightly levered covered call version, so want more or are able to take on a little bit more risk and a little bit more NAV volatility in order to get a little bit of upside, higher upside potential and higher income stream. So again, a lot there to take away and to unpack. As I said right off the top, really a lot of drivers that are really setting us up for what we think is the next commodity super cycle. These cycles take anywhere from, again, 5, 10 to 15 years to play out. And so long-term in focus, certainly some headwinds that could meet some of these, that could create short-term volatility. Generally, we see those as buying opportunities for those that want to take advantage of this commodity super cycle and participate in what we think is this long-run increased demand from newer sources, newer demand sources that are going to increase prices of these commodities and therefore the equities that benefit from them as well. Maybe just the last thing we can leave here. I think we're starting to run low on time, so want to just finish it off here for everyone. All the different tickers that we've mentioned today and what exposures they have exposure to. Again, most of these are equity-based portfolios. For those that want direct exposure to the price of the commodity, we have some of those as well. But really going back to the equity side of things, again, low correlation to other equities here. So on the gold side, I mentioned a 0.4 correlation. The highest on this range is the lithium producers. That's about a 0.58 correlation, and this is over the long term versus those broad equities. So anywhere from 0.4 to, let's call it 0.6 correlation to other equities, very attractively valued as well. So as you're looking for diversification away from those higher valued tech-oriented sectors and markets, this is a great way to get exposure to what we think is a super cycle. It's going to play out over the long term and still gives you a very nicely valued way in order to enter into that. So we're going to leave it there today. We've run out of time. Sorry, we can't get to any of the questions that have been submitted in advance, but we will do our best to get back to each of you that have submitted those questions over time. And stay tuned for the next webinar that we have next month. Actually, next week or two, we're going to have another one. So keep your eye out for that as we bring that to you. And thank you for your time this afternoon.